Hello, everybody. This is the July 2022 monthly market update, where I'm going to be going over some collection of news articles that I thought were relevant for investors out there. And if you guys are interested in getting to know us and our community a little bit better, join our group at simplepassivecashflow.com/club. There we'll be sending out invites. We've got a mixer in Los Angeles, second week of July, and then third week of July, Arizona. So if you guys want to be invited to those events and not have FOMO because they're at home, wondering that you're the only accredited investor out there investing in real estate all by yourself, you guys can join up with those groups. Um, Also, check out my book, The Journey to Simple Passive Cash Flow, which you guys can access. That's a little hint by listening to these videos. You guys get the little hints here, there, which is to get the free audio version at simplepassivecashflow.com/book. And you guys also can check out these recordings. We keep them at simplepassivecashflow.com/investor letter. So if you want to go back to all the past months reports and kind of see which what I'm saying and catch me if I'm lying or saying that it's a good market or bad market or not, you guys can go back to those archives there. But first thing, I think everybody's talking about interest rates creeping up, but this kind of was a nice chart that I found where it kind of showed like the points in the timeline when the Fed increased the rates quite a bit, and how long of an increase was it before they backtracked and where they realized, oh shit, we manipulated the interest rates too high and the economy is getting crappy. We better stop doing that. So again, a lot of this, if you guys are listening in the podcast form, which that's kind of our main channel, but we also put this up on the YouTube channel. And to make it confusing, there's actually two YouTube channels. There's the Simple Passive Cash Flow channel, and then there's the Rich Uncle channel, which is more geared towards the non-accredited investors out there, where the accredited investors should check out more Simple Passive Cash Flow stuff. But what we're looking at here is, there's been 1, 2, 3, 4 times in the history, not including now, from 1990 to 2022. So the last 30 years where there's been periods where the Fed has increased rates gradually. And right now we're in a bit of an incline right now. Nobody knows how long it's going to go. But what I'm personally looking at is, is the unemployment going to start creeping up? Because right now, a lot of the metrics are looking really good. And, I follow like ITR economics, they're kind of an unbiased type of data source that I look at. And, a lot of things are looking good. I don't know where a lot of people are getting this, all this doom and gloom type of stuff. And even look at the doom and gloom people, a lot of them are broke, which is why, they're always just looking for excuses not to do anything. This time it's kind of unique. I mean, the reason why they're increasing interest rates is because inflation is so high, which means if you don't do anything and just play, oh, there's doom and gloom, I'm just going to sit on my butt and not do anything and just sit on cash, you will lose 9-10% of your money every single year. Um, but yeah, if you this is so we want to keep this interactive, folks. So if you guys have any questions or comments, please type it into the chat below. Um, but yeah, next article here from Wallet Hub: best and worst places to raise a family. Now, I always look at, these, there's so many of these types of like top 10 places, and sometimes they don't mean very much. Just on, if you're kind of looking to move, the top 10 places: Fremont, California; Overland Park, Kansas; Irvine, California; Plano, Texas; Columbia, Maryland; San Diego, California; Seattle, Washington; San Jose, Madison; Scottsdale, Arizona. So may or may not be the most um, may not be the best places to invest, but supposedly these are best places to have a family. Honolulu is out there at 34. But if you're like me, you want to know where the worst places are because you like to tease those places. Some of those are like Detroit, Cleveland, Memphis, Birmingham, San Bernardino, California, Newark, um, Fayetteville, Shreveport, Jackson, Mississippi, and Augusta, Georgia. So Bitcoin.com, billionaire Sam Zell, which is a real estate guru out there. He says, I've stayed away from Bitcoin at all costs. Sam, whose net worth is estimated at $5.8 billion, reiterated that his anti-Bitcoin stance Thursday in an interview with CNBC. And I quote, he says, I basically stayed away from Bitcoin at all costs. I think that's when that it's all said and done. Any kind of a currency without the backing of a government is in some fashion unlikely to work. Well, I mean, I think Warren Buffett or his other buddy, Munger, said they would never invest in like Apple and tech companies, but they eventually took up a big holding. I'm not a big fan of. Actually, I do like how these cryptocurrencies, Bitcoin and Ethereum, in for the most part, because they're more of the blue chip type of cryptos, are here to stay. But I mean, I just don't invest with it, especially now with all the turmoil with all like these big companies, which are like the kind of like the act as brokerages, are going under. And I think I actually have a long video on this like crypto winter. It'll probably be released next week. YouTube got angry at us because we didn't use free music, so we have to rework that. We'll probably get it out later on this week for you guys on the Rich Uncle channel. Wall Street Journal reports that bidding wars overheated the home buyer market. Now they're coming for renters. So bidding wars have been long staple of hot housing markets where buyers compete with offers above the seller listings price. Now with the home buyer pricing kind of going back in the favor of the buyers, well, um, now that they're also saying that an increased number of white collar professionals, some who recently sold houses, are reluctant to buy because of record high home prices, rising mortgage rates, which ultimately is affordability. They're renting instead. And this is kind of driving up the demand. So it's good if you're a landlord on the right side of this. The median US asking rent price passed to $2,000 for the first time in May. Um, if there's one thing I'm going to kind of, if I would like to gamble on something, is like rents don't really go down for long periods of time. Now, what's a long period of time? I don't know, like 1 to 3 years or greater. Kind of a big range, but it's just in my opinion, it's just not something that really goes down. John Burns, real estate consulting, they're talking about the demand shifting from owning to renting. I still rent, folks. It's cool. I'm not a loser because I don't own my own house. I invest it instead, and they make a lot more at the end of the day. Paying rent, yes, it is technically like throwing money down the tube. But if you have your money sitting in your home equity doing nothing, that is even worse. So you got to look at it holistically. So they kind of broke down the cost of owning versus renting single family homes. And a little over a year ago, the monthly cost of owning and renting were virtually identical. And that's kind of what we call in the engineering world the crossover point. We love the crossover point. Hey Lloyd, yeah, let me know when you want to speak to the LA group again. Like to do it, especially if it's virtual. I like that virtual stuff, so I can not travel and be away and kind of sleep in my own bed. That was the thing. I was traveling a lot for work. When I did work, and this sucks. Like some people get off on like getting all these frequent flyer points and having high status, and like, all right, that's cool, but each their own. I just don't think that that's all. I think that's a little overrated. Again, each their own. I don't want to offend anybody out there, but that's just not my thing. I prefer to stay at home. Um, so they're also saying Raleigh, Durham, Nashville, Denver, Tampa, and Phoenix have all witnessed the biggest disparity in increasing home ownership versus rental costs. Again, you guys can take a look at all uh, these charts on the YouTube channel if you really want to geek out on on the uh, on the numbers. Matthew says it's a long-term game. Don't worry about the short-term GDP numbers. I guess while we are talking like GDP numbers, I mean, last quarter, like a recession is defined as 2 quarters in a row where you have negative GDP growth. Last quarter was negative 1.5, which sounds not the greatest. And typically we're trekking upon like 2 to 3% is what the Fed would like. But the year prior, 2021, like we hit like 20 something percent. So yeah, relative speaking, that was a horrible quarter. But to me, it's just like a lot of pent up demand flushing through the system. And I would actually expect, I mean, the 20% is ridiculous. It's also ridiculous to shut down a country for about a quarter or two. But I just think overall, I mean, you even look at it from like a 1 year trend line. I mean, you're still doing pretty dang good. And I don't know where all this doom and gloom is going. I mean, I'm cautious, don't get me wrong, and buying off good debt service coverage ratios, but um, I don't know. I just think people really like um, doom and gloom, fear porn. I heard of that. Friend used that one. Fear porn. I like that. Junior says you're offended. Sorry, Junior. Sorry you're offended. I try not to offend people. Um, so, Joint Center for Housing Studies at Harvard says that record-breaking home prices and rents likely to cool as interest rates climb. Thank you, Harvard, for pointing out something super obvious. But if this is new to you guys, so what's happening is as the interest rates climb, because again, the Fed is using interest rates to cool off inflation, which is pretty high right now. Um, the interest rates is important because that impacts how much people can borrow, or in other words, affordability. So people can't afford that mortgage that they couldn't afford in the first place. They couldn't afford it in the first place. They sure can't afford it now with the interest rates going up, which is why we don't know if there's more supply, less demand. We don't know, but the prices is sort of a composite of that. And we do know is like the prices aren't going up at the same rate that it once was in the past year or two. And nor would I say that those two uh, increases from the last few years was sustainable. Again, and this is where a lot of people are like, "Oh my God, it's slowing growth. The world is over." And it's kind of like saying like, "Oh, like it's still growing, guys. Like, just because it's not going up 20% or rents aren't going up 20%, like in 2021, doesn't mean the world's coming to an end." Um, So with interest rates rising on top of the double-digit home prices increases, the income and savings needing to qualify for a home loan have skyrocketed, which is a really wordy way of saying that affordability is taking a hitting. Um, Potential home buyers saw monthly mortgage payments on the median price U.S. home rise by more than $600 over the past year. So, I mean, and that's on the monthly payments. So $600 for most people is a big chunk, for sure. Last takeaway from this article, these Joint Center for Housing Studies, if you guys are always looking for good stuff to read, that's not just like your Yahoo Finance and CNBC stuff. These are actually pretty good, insightful articles sometimes. Sometimes they don't tell us anything, and that's why I try and throw some of this stuff out. But they're saying renters were particularly burned in the first year of the pandemic. Job and income losses early in the pandemic increased affordability challenges for millions of households who are already struggling. And this is talking about how the pandemic wasn't really fair, right? The higher end, the people in the B plus A class housing lived work from home, they order the Uber Eats, and they continue to work at their computers. Where the people who are on the lower end, your Class C, Class B housing, your renters, your workforce housing, or your workforce that live in workforce housing, are the kind of the grunt workers out there, and sometimes their jobs kind of was cut off because of the pandemic shutdown. John Burns reports that in the first 3 weeks of May, 30-year mortgages hovered around 5.25 and eased just above 5% by month end. Um, as for sale demand weakened, single family rentals outperform. Um, these are be good for you guys to take a look at. Again, we post that at simplepassivecashflow.com/investor letter. John Burns. Yeah, these things are kind of meaty to kind of go over in the video and the podcast version. So we'll skip ahead to a real page. They're talking about U.S. apartment market showing no signs of slowing down yet. So this is where I'd like to separate like the residential housing world, which is based on comparable sales, which is based on not investor sentiment, but like just regular average people who need a house to live in. Affordability, interest rates are a big thing to them, whereas this is more on the commercial side. Um, you know, not seeing a quite slowdown yet. In fact, we're actually, as of right now in July 2022, I would say that we are still in a micro bubble where we're in a buyer's market. You're probably wondering, what the heck is Lane saying? It's a buyer's market? Yes, because a lot of the institutions, the guys who really move the markets that are buying up big apartments and commercial assets, they pulled out about like a month ago and just kind of did nothing and just waited to see the situation, which greatly takes out a lot of the demand and the supply demand dynamic. Therefore, there's a little bit more supply than demand out there than there is normally, which creates a buyer's market. So there's a little bit of a buying opportunity right now, and but that's typical, right? Like when things are kind of uncertain and people are kind of like, what do we do here? That's kind of the time to be buying. Of course, every deal is pretty typical, or every deal is individual, and I'm just speaking in generalities. But that's why I think if you're out there looking for more of these commercial larger deals that institutions might be looking after, like a 200 or 500 units, there might be an opportunity before those bigger players come back, and they'll come back in because they have to buy. And this should make people sick to their stomach. These large institutions and REITs, they get most of their money when they deploy capital, so they got to come back in to pay for their own salaries at some point. Which I would probably say maybe next year is kind of when this little micro bubble will close up, or next month when this micro bubble will close up and it kind of gets back to normal. So markets with the steepest replacement rents as of May. Reading off from the top: Miami, New York, Fort Lauderdale, Tampa, Orlando, San Diego, West Palm Beach, Nashville, Seattle, Newark, New Jersey. Among individual metro areas, Florida remains home to some of the largest rent increases. Among the 50 size metro areas, the smallest increases generally came in the Midwest and the Northeast. No surprise, because who wants to live there? Sorry, Junior, if you're offended by that. Just joking. He identified himself as the canary in the coal mine offended person. But Midwest and Northeast, nobody wants to live there apparently anymore, because they're all moving away because like maybe it's too cold. Whatever it is, that's what the numbers shows. Most of the people are moving down to the south, the Sunbelt states. MultiHousing news. Out-of-state rental applications rose 42% during the pandemic, says the TransUnion, um, which means that people are moving out of state. Texas had the largest increase in new residents between 2020 and 2021, with more than uh, 310,000 residents, while New York saw the highest decrease, losing about the same. More people were leaving California, the Rust Belt, and Northeast, and heading to the Sun Belt and Rocky Mountain regions. Wow, didn't I say that last time? Um, the top 10 multifamily markets by sales volume in 2021. Um, just reading them up from the top to the bottom. Dallas, Fort Worth, Atlanta, Phoenix, Houston, Denver, Miami, Washington, D.C., Orlando, Tampa, Petersburg, Tampa, St. Petersburg, Raleigh. Now, I would I just want to point out just because there's a lot of like sales volume doesn't really mean too much because like some of these are much larger markets than others. And just because things are being transacted there doesn't really mean anything. But I think it's just like for people looking for anomalies in the data, this would be kind of a one of those to put on your radar. But out of these 10, none of these really surprise me. You always see these ones up there. Now, top multifamily markets for construction activity. So these are the where you're going to see the most units come online. And at first gut reaction, you would think that this might be a bad idea. I don't know. From one point of view, you could think of this as a bad idea because if you have an apartment in, say, Dallas, which is number one, that's more competition coming online. But on the other hand, it's like, well, why the heck are these super smart development companies building stuff over there in the first place if they're the demand? So take it for what you guys want. But here's the list, and from the most to the least: Dallas, Austin, Phoenix, Washington, D.C., Miami, New York, Los Angeles, Atlanta, Seattle, Denver. Uh, and it's kind of the same same information, but from Real Page. Most apartments under construction: Phoenix, Austin, New York, Dallas, Washington, D.C., New York, Atlanta, Los Angeles, Seattle, Denver. And it's pretty much the same thing. So, that's what meta-analysis is. You compare two or more articles, which we just did. So commercial property executives talking about 5 states that are corporate relocation magnets. So what's making these people relocate there? Maybe there's a more influx of headquarters. I know a lot of them are going to like Texas every day. But yeah, number 1, Texas, number 2, Florida, number 3, Arizona. No surprise there. Just to name a few. So Texas is Tesla, Digital Realty, Oracle, AECOM, Hewlett Packard. We have a lot of engineers in our group, so I think most of them have worked for AECOM at some point in their life. Florida, companies like blockchain.com, Block Tower Capital, the Walt Disney Company, Skywater Technologies. And in Arizona, companies like Sendoso, Move, and Align Technology. I don't know what these companies are, but I know Arizona has a lot of the growth on the semiconductor front. We don't want those, the people out of the east to take our. They kind of took our lunch with the whole semiconductors back in the day, but now we're gonna try and beat them at their own game, or that was once our game with the semiconductors out there with Intel. If you guys are all interested in that, just like YouTube TSMC Intel and then that articles, those videos will come up. But other states are Georgia and Tennessee. 1.25 battery gigafactory set to rise near Phoenix. Apple is at least a newly construction office in Sunnyvale, California. And I put this one in here just to note that, tech companies aren't completely abandoning all their office space, folks. I mean, it is coming back. Who knows if it's going to be the same as before, but I mean, I think companies are starting to realize that the need for a physical presence is a real thing. CNBC Business. There's an article on like, is it time to prepare for a recession? So they're saying the economies are close to entering recession, perhaps as soon as this year, to avoid taking too much of a financial hit. Americans will need to prepare. Uh, where do they? Okay, what are they saying here? They're saying that there's some economic headwinds with war in Ukraine, COVID lockdowns in China, reply resulting in supply shocks that boosted inflation and slow growth. A key part of the inflation problem is linked to the massive 3.9 trillion in fiscal stimulus injected into the economy in 2020 and 2021. That's why everybody's stock market stuff blew up the last couple of years, and why you're starting to give it back now. Um, and they're saying for the average investor, it's hard to find a place to hide. Recessions are usually accompanied by outright bear markets, with stocks falling by well over 20%. And with now Fed now hiking rates aggressively, the bond market is no safe haven. Equities and bond markets are riskier than usual. What can Americans do, says CNBC Business? Well, one answer may be do to nothing and just try to ride out the volatility without trying to time the market. Um, that was probably written by some financial planner. Says, oh, it goes up and down. You might as well just stay where you're at, and I can keep my assets under management fee with you. Um, they also say, well, consumers might consider cutting back on non-essential spending, especially avoiding splurging on big ticket items. Um, yeah, kind of a crappy article. Here's my take off the top of my head. I would like, I would I guess, is this the right term? Monetize my HELOCs. If you guys have HELOCs, I would get that into cash and put it into like life insurance. That way you can control it. So if they ever do pull those home equity line of credits, you're not at the bank's mercy to arbitrarily just randomly do that stuff. Um, I would also say, this is why you invest in cash flow, right? The people who got hurt back in 2007 and 8 were the idiots who were betting on appreciation. And when things went down, they couldn't pay their debt service. So that's what it comes down to. It's not a loan to value thing. It's a debt to service coverage ratio. And especially with like your guys' homes that doesn't make any money, it's not how much equity or loan to value you have. It's um, what's your debt service coverage ratio? Well, you're probably saying, well, you're being a smart ass lane. My house doesn't have any debt service coverage ratio. It doesn't make any money. It's like, well, that's exactly why you shouldn't have it in the first place. In my opinion, unless your net worth is 2 to 3 times greater than what your house is worth. So if you have a $500,000 house, I don't think you should buy a house until your net worth is 1.5 at least. But that's why they call me rich uncle, and I'm kind of like a cranky uncle in a way. And you can hear more of that on that YouTube channel. Fannie Mae's article here, they're talking about rapidly rising rates, persistent inflation, and further soft economic outlook. Kind of like what the last article was saying. They're saying the expectations that the full year 2022 real GDP growth will be at a reduced rate of 1.3%. So positive, right? But they're kind of reducing their initial guidance a little less than 1%. So, but that's technically not a recession, right? Recession is 2 negative quarters in a row. But here's the thing, right? Like when nobody knows when this recession is going to end. No, I actually, quite frankly, think we're kind of in a relative recession right now. But the hard thing is you can't time the market. Like when this thing goes, unless you're playing in the game, and the hard thing with real estate, it's like you can't just come back in. You can't time the market. So as soon as you think it's coming back, you've already lost it already. Wealthmanagement.com, they're talking about rising interest rates aren't stopping apartment investors from cutting deals. Fed plans to continue to rise interest rates to help stem inflation, and that's changing the math for apartment investors looking to make deals. Other factors, rising rents. Rents are still going up and are offsetting the interest rates. One thing that I'll say that's not in here that's kind of hurting cash flow now is like because the property values are going up, the property taxes are going up, and that's can take a huge chunk out of not a huge chunk, but like like 10 to 20% of like your cash flow on the property taxes. In the end, that's good, like because your property is going up in value, and you don't get to realize that until the end. Um, but that's kind of the big thing there. Uh, Oh, I'm glad you did this, Matt, because I'm gonna troll you right here. So, like, this is probably one of the biggest mistakes I see investors make is that you have maybe $200,000 of equity in your house, and you think of it in terms of like how most people think of it, where like you're borrowing at like 2.7%, which is a great interest rate, but that's not how sophisticated investors think of things. They don't really, yeah, interest rate is kind of important, but they don't care about interest rate. They care about your net worth, what's happened to your net worth. So the important thing is to like, what can you do with that $200,000 of equity and put it elsewhere? You could probably buy like three other or four other houses with that. But I think the biggest thing is like if you can get into the value add game, um, I think there's a lot of like lower net worth investors doing that buy rent rehab burst strategy. But for a lot of accredited investors, that's just a waste of time, especially if you make multiple six figures doing that type of stuff, and you're working with little pull down contractors who just are like one day from stealing your money. But take a look at what I would say is like look at um, simplepassivecashflow.com/ROE, return on equity. Download the spreadsheet and just follow the numbers, right? After a certain time, when your equity goes up, your return on equity goes down. And after time, you're probably making like less than double digits. At that point, you need to do one or three things: do a HELOC, buy more assets with that HELOC, or do a refinance, buy more assets with that, or sell the asset and divvy that up into more and more assets. Essentially, re-leveraging yourself back up to that 80% loan to value that you started, and just kind of keeping that value high. But what do I know, right? I don't have 8,000 properties, so but anyway, Fortune magazine says the cooling housing market enters into the great deceleration. Um, Inventory levels are rising again. Um, but I think the cool thing about here is it's kind of cyclical too, which you can see definitely inventory coming down. The cooling housing prices enters the deceleration. So they always kind of come up with these like little marketable terms to sell headlines, like the great deceleration, or the other one I heard was oh, I can't even remember it, but it's kind of stuff it's simple, folks, right? Like inflation is high because they pumped a lot of fake money into the economy the last 2 3 years because of the pandemic. Um, who knows what else they're hiding? But that's what happened, and like the stock market is high because of that, and because they pumped a lot of this money in there, inflation is high. So inflation, they need to kind of keep that between 2 to 3%, and that's what the Fed is mandated to do, so that they can keep the highs relatively moderate, and but more importantly, keep the lows not as low, and which is why are increasing the interest rates to get some dry powder there now. But they don't want to do it too much to crater the economy, and which so they have to look at things like unemployment because it is it's a it's a sensitive game, right? It's complicated. Um, First, the Federal Reserve have moved into inflation fighting mode, says Fortune. Second, the overheated 2022 spring market has pushed us over the edge into housing economist calls an overvalued housing market. Yeah, I would probably say things are a little bit overheated, but here's my crystal ball. It's like I don't really care. Like to me, it's like NBA Finals. I don't care if the Golden State Warriors win. And I don't know who else. Who did they play? I guess the Heat, right? I think they played the Heat. I don't care if the Lakers aren't playing, but like that's how I kind of look at the residential housing market. Like I don't really give a rip where it goes, but if I were to guess, I think that there will be some softening, but um prices might go down 5%. But I don't think if you're a person out there, you can time it unless you like you're like a realtor. It's just gonna keep going up and up and up after this. We're in a fiat currency world. I mean, it's all fake money at this point. As long as the Fed can kind of keep inflation under control, I mean, it can kind of keep going like this forever. Zillow says that the most popular markets of early 2022 pricey suburbs top list were Woodinville, Washington, Burke, Virginia, Highlands Ranch, West Chase, Florida, which is Tampa, Seattle, Los Angeles, Atlanta, Los Angeles, San Diego, San Luis, and Denver. I don't know if that's useful for people, but that's I guess those are great places to live. Um, I don't know if they're great places to invest. RealPage reports neighborhood level resident retention levels. So retention levels are when tenants are turned over, not turned over, but they renew their contracts to stay, and it could be for a variety of reasons. But see me like if they are staying as renters, this may be a sign that they're not able to step up to home ownership or they're not economically mobile. So um, obviously the best retention rates, as they're saying here, is class B and C because those are your less economically mobile people. Like we had I would say a couple of nicer class B plus type of assets, and a lot of the people there, they jumped ship because interest rates were really low a couple years ago and they moved up, which kind of sucked for us. It's kind of like if you have a good employee and then they leave you because they're good, it kind of makes you sad. It's kind of the same feeling that, um, but that's the class B and the C are the type of residents that do stay. Some stay all their lives, actually. Uh, some markets with the best retention, Indianapolis, Cleveland, Milwaukee, New York, Miami, San Diego, Riverside, Boston. And wealthmanagement.com, in this article, I'll just summarize. Basically, Class A apartments are going up in price higher, where the Class C, the lower end stuff, isn't as much. And this is kind of obvious why, right? Like, because the higher end stuff, they're a little bit less price sensitive, where the Class C stuff, people, they are more value driven. And also, I think coming out of the pandemic, as I said earlier in the show, people who are Class A type of tenants, they had a much easier time through the pandemic economically, where a lot of the Class C workforce housing folks had a tough time. And we had some folks. I mean, sometimes we'll work with the church, and they'll come in and they'll like sit down with the people and help them, do job applications and stuff like that, or the people from like the mall will come in, put up flyers, and like it's just I don't know. It's tough. Like I say, money doesn't make is not everything, but it sure makes life a lot easier. Multi-housing news reports that New York says no to a good cause eviction bill. So this is kind of a landmark type of article, and this I would say look at bills like this to kind of set precedents. And so basically, what happens? New York State ended its legislative session without taking action on the proposed good cause eviction bill, a decision that was cheered by multifamily industry representatives who say it amounts to another form of rent control and will hinder rather than create affordable housing. And um, so basically, it's not rent control happening, the opposite of that, I guess. Um, and this kind of bounces back and forth, back and forth. I think the last landmark type of article we had that maybe happened several months ago in California, where they started to allow in single family home zoned areas, they allow multifamily zone areas, which you know it's essentially a democratic republican argument where like the affluent areas don't want multifamily in their backyard. But the prices get so expensive, expensive. What are you going to do? So these states are like New York and California, um, and Oregon and Washington are typically more. They deal with the stuff first, right? Like they're kind of on the forefront, and they in a way set precedents for the states to come after. But if you're somebody who's against rent control, this was kind of a good one for you guys. I just think that this is eventually things typically go in the favor of rent control, and that type of stuff. Um, New York to transform distressed hotels into affordable housing. This law allows for Class B hotels to use certificates of occupancy to operate as residential spaces. Um, add more flexible rules for converting underutilized hotel space into affordable housing. Um, and there's also time to type any questions you guys have into the chat. But if you guys haven't joined our group, you can go to simplepassivecashflow.com/club. And if you guys are an accredited investor and really tired of just screwing around with all these non-accredited investors out there, and you want to find a close-knit private group, check out our family office Ohana Mastermind, which is our inner circle, at simplepassivecashflow.com/journey. Um, Pretty much everybody's accredited in that group these days. There's actually 90 members now. This is kind of outdated, but we no, you just have to come to the events and talk to the other full members. I would say it's kind of hard for me to kind of go over it. But yeah, we'll hit you guys. Hopefully, I think Junior was offended earlier. We made amends. I should probably watch myself and my jokes before we need a meet in person, which I think we will. I think I saw your name on the list for Los Angeles, so we will meet in person, and then we can offend each other. But if not, no questions. We will see you guys. Thanks, Andrew. Um, yeah, thanks for your comments. And then Matthew, no hard feelings. You get that VA loan. Good for you. I mean, that's why you do all that service, right? But yeah, Matt says I'm offended by people being offended by Lane's jokes. Yeah, yeah. Well, thanks for leaving those comments. It makes me not quiver, uh, walking around watching myself behind my back. Someone's gonna shank me or something. But we'll see you guys next time, and stay calm, cash flow on.